Welcome to the most detailed crypto strategy experiment ever created on YouTube. This is not a short tutorial. This is not a quick trading guide. This is a long, slow, transparent, and brutally honest journey. Over the next several hours, you will see exactly what works and what fails in the world of crypto trading. I tested 5 different crypto strategies. I followed strict rules in every strategy. I checked every single trade with complete honesty. I recorded every win and every loss. And at the end of the experiment, only one strategy survived. The remaining strategies either failed or produced unpredictable results. This experiment took discipline, patience, and absolute transparency. I did not hide losing days. I did not remove bad trades. Everything you see in this video is 100% real. The purpose of this project is to reveal the truth about crypto trading. Most people lose money because they follow hype. But real trading requires structure, rules, and consistency. Before we begin, let me explain the foundation of the experiment. Without a proper structure, no strategy can be tested fairly. No matter how advanced the strategy looks, without rules it becomes useless. So this entire experiment was built on equal conditions. All 5 strategies used the same starting capital. All 5 strategies were tested for the same number of days. All strategies used the same crypto pairs. I did not switch coins randomly. I did not change timeframes in the middle of the test. I did not adjust risk settings to save a losing strategy. Everything was kept equal for fairness. The starting capital for each strategy was $1,000. I chose this amount because it is realistic for most beginners. Some people start with less. Some people start with more. But $1,000 is a simple, balanced number for testing. Each strategy had its own separate wallet. No money was transferred between strategies. Losses stayed where they happened. Profits stayed in their own system. This kept the results clean and accurate. Every active strategy used a stop loss. Stop loss is the difference between surviving the market and blowing your account. Crypto moves fast. A coin can drop 10% in minutes. Without a stop loss, even a good strategy can fail instantly. Passive strategies did not need stop losses because they were long-term. This created a clear difference between short-term trading and long-term investing. And one more thing I want to make absolutely clear. This video is not financial advice. This is a real-world trading experiment created for education. Always do your own research. Crypto is unpredictable, and anything can happen at any time. The purpose of this video is to reduce fear and confusion, to give beginners clarity, to help people understand what actually works in the long run. Before starting the test, I built a detailed trading journal. Every trade was recorded. The entry price was recorded. The exit price was recorded. The date and time were recorded. The reason behind every trade was written down. And even the emotional state during the trade was noted. Emotions matter more than most people realize. Emotional trading destroys discipline. Emotional trading leads to revenge trades. Emotional trading leads to over-leveraging. This experiment was not only about profits, it was also about psychology. All strategies were executed on the same exchange. This removed platform bias. Some exchanges have higher fees. Some have slower execution. Some have different price feeds. Using one exchange kept conditions fair and equal. The crypto pairs used in this test were Bitcoin, Ethereum, and BNB. These coins were chosen because of their strong liquidity. They are stable. They are consistent. They form the backbone of the crypto market. Using low-volume coins would make the test unrealistic. Using only meme coins would turn the experiment into chaos. So the foundation of this test was stability and fairness. But even stability does not guarantee profit. That is what makes crypto so interesting. Even with rules, structure, and discipline, the market can surprise you. This is why I tested multiple strategies. Because no single approach works in every market condition. Trends change. Momentum disappears. Market sentiment shifts. A winning strategy can suddenly stop working. Consistency comes from understanding which strategies perform best long-term. In this video, I will show you the performance of each strategy. I will show you the charts. I will show you the live trades. I will show you the entire thought process behind every decision. You will see how fast emotions shift during volatile markets. Some strategies felt calm and comfortable. Some felt stressful and chaotic. Some produced small but steady gains. Some produced fast profits but even faster losses. And only one strategy delivered consistent results. This is not just a video, this is a documentary of discipline, a documentary of doubt, a documentary of patience, a documentary of truth. My purpose here is not entertainment. My purpose is education. I want to show you the information I wish I had when I started trading, because I made mistakes. Big mistakes. Mistakes that cost time, mistakes that cost money, mistakes that destroyed confidence. This experiment is designed to help you avoid those same mistakes. By the end of this video, you will know which strategies to avoid. You will know which strategies actually work. You will know how to trade with clarity and structure. And you will know how to trade with confidence. So let's begin this journey, a journey of data, a journey of real results, a journey of honest trading, and a journey toward discovering the one strategy that truly works. Let's begin with strategy number 1. Trend following is one of the oldest and most trusted approaches in financial markets. 2. This method focuses on identifying the direction of the market and staying aligned with that direction. 3. The idea is very simple. Buy when the market shows strength and sell when the market shows weakness. 4. Even though the idea sounds simple, executing it properly requires discipline. 5. Crypto markets move faster than traditional markets, which makes this approach even more interesting. 6. The goal is to capture the big directional movements that happen during strong bullish or bearish phases. 7. To make this process more structured, indicators are used to confirm the direction. 8. The most commonly used indicators are moving averages. 9. Moving averages smooth out price action and show the overall direction more clearly. 10. Many traders use combinations like the 50-day and 200-day averages. 11. When the shorter average crosses above the longer average, it is considered a bullish signal. 12. When the shorter average crosses below the longer average, it becomes a bearish signal. 13. These signals help traders decide when to enter and when to exit. 14. Instead of predicting the top or bottom, trend followers react to what the chart is already showing. 15. This approach avoids emotional decisions because everything is guided by rules. 16. In this testing session, the trend-following approach is applied on multiple crypto assets. 17. The data includes large-cap coins like Bitcoin and Ethereum. 18. It also includes mid-cap coins that experience strong momentum phases. 19. Each asset is evaluated on daily timeframes for long-term consistency. 20. Backtesting tools are used to simulate how this method performed in the past. 21. Data is collected for multiple years to avoid bias. 22. The system checks how many times crossovers occurred. 23. It measures how long the position remained open after each signal. 24. It records the profit or loss of every entry and exit. 25. It also calculates overall return, maximum drawdown, and consistency. 26. Only directional trades are taken. 27. No leverage is used to maintain accuracy. 28. Fees and slippage are included to simulate real trading conditions. 29. One major advantage of trend following is that it filters noise. 30. Instead of reacting to small movements, it focuses only on major shifts. 31. This can reduce the pressure of watching charts all day. 32. Most trend following systems require only a few checks per week. 33. The method is easy to automate using bots or scripts. 34. The biggest drawback is that this approach struggles during sideways markets. 35. When the market moves without direction, the method generates many false signals. 36. These signals can lead to small losses repeatedly. 37. But when a strong trend arrives, the profits can be large. 38. The system works because a single big move often covers all the smaller losses. 39. Crypto markets regularly create massive moves during bull cycles. 40. These moves can stretch for months or even years. 41. This makes crypto an excellent environment for this method. 42. Risk management is a core part of this approach. 43. Each position is sized according to volatility. 44. A trailing stop is used to lock profits when the trend reverses. 45. A fixed rule controls the maximum amount of capital used per trade. 46. This prevents emotional overallocation. 47. Some versions of this strategy use additional indicators. 48. A popular addition is the relative strength index. 49. The index helps confirm whether the market is gaining momentum. 50. If the indicator aligns with the moving averages, confidence increases. 51. If the indicator disagrees with the moving averages, caution is necessary. 52. Other traders use price structure patterns like higher highs and higher lows. 53. These patterns give visual confirmation of trend direction. 54. A series of higher highs typically indicates upward strength. 55. A series of lower lows usually signals downward momentum. 56. Combining these tools increases accuracy. 57. The method becomes more reliable when multiple confirmations match. 58. During testing, results show that the approach performs very well during strong bull runs. 59. Profits grow rapidly when the timing aligns with early breakout signals. 60. Early entries help capture most of the upside movement. 61. Exits based on crossovers prevent holding through deep corrections. 62. The worst performance occurs in choppy periods. 63. During these phases, price constantly moves up and down without direction. 64. This environment is known as range-bound movement. 65. The system loses its advantage because it cannot latch onto a trend. 66. Many small losing trades occur during ranges. 67. These losses accumulate until the market breaks out again. 68. Once a breakout forms, the method begins to recover losses. 69. The long-term success depends on patience. 70. Many traders quit during the noisy periods. 71. This prevents them from benefiting when a major trend finally emerges. 72. Trend following is a strategy that rewards discipline more than prediction. 73. The approach has been used by large funds for decades. 74. These funds have proven the method works across multiple markets. 75. The same principles apply equally well in the crypto space. 76. This test confirms that the method can be profitable when executed consistently. 77. The win rate is usually low because many trades fail. 78. The profitability comes from the size of winning trades. 79. One strong move often covers many losing positions. 80. This characteristic makes the method unique. 81. It does not require predicting tops or bottoms. 82. It only requires responding to price direction. 83. The approach shines in volatile environments. 84. Crypto is naturally volatile, which amplifies results. 85. The method is scalable using multiple assets. 86. Position sizes can be adjusted based on volatility. 87. Risk remains controlled through rules. 88. Emotional bias is removed because decisions are systematic. 89. Overall, trend following proves to be reliable in directional markets. 90. The real challenge lies in handling the sideways phases. 91. Traders who endure those periods often see better long-term performance. 92. This concludes the deep explanation of the second method. 93. The next section will examine another approach. 94. The testing continues with strategy 3 in the following part. Mean reversion is built on the belief that price eventually returns to its average. This idea assumes that extreme movements are temporary. When price rises too fast, the method expects a pullback. When price drops sharply, the method expects a rebound. This approach works in many traditional markets. Stocks and commodities often show stable reversion behavior. Crypto behaves very differently from slow-moving assets. Crypto markets move aggressively in both directions. These fast swings push price far from the average for long periods. This makes pure reversion difficult without adjustments. In this testing session, the approach is examined on multiple crypto assets. The analysis includes Bitcoin, Ethereum, and various mid-cap coins. Indicators are selected to identify overbought and oversold phases. The relative strength index is one of the main tools. When the index moves to higher zones, the market appears overbought. When the index moves to lower zones, the market becomes oversold. Another important tool is the Bollinger Band structure. Bollinger Bands track volatility and create upper and lower zones. Price touching the upper band shows excessive strength. Price reaching the lower band shows excessive weakness. These tools help identify potential turning points. The system uses these conditions to enter reversion trades. When the market is overstretched, the method expects it to return back to normal. Crypto markets, however, can stay overstretched for long durations. This causes entries to trigger too early. Early entries lead to long floating drawdowns. Volatility increases the difficulty. Sharp, unpredictable moves break normal reversal zones. Tight stops often get hit quickly because of whipsaws. Wide stops increase risk dramatically. Balancing stops becomes the main problem. During testing, the approach is applied to many years of daily data. Historical performance is measured carefully. Profits, losses, and drawdowns are recorded. Every overbought and oversold trigger is analyzed. The results show good performance during stable phases. When markets move inside tight ranges, the method performs well. These phases allow repeated reversal trading. The approach becomes consistent in such environments. Problems appear when a strong trend takes over. Crypto bull phases last months without strong dips. Crypto bear phases continue for long without meaningful recovery. During these phases, the method performs poorly. Reversal triggers appear too early in strong trends. This creates multiple losing positions. Losses accumulate rapidly as price continues in one direction. The method depends on market balance, but crypto rarely stays balanced. The approach becomes unstable in explosive environments. A wider threshold can help reduce early entries. This improves accuracy but reduces opportunities. Another improvement is blocking trades during obvious trending phases. This requires a way to detect trends in real time. A hybrid system mixing reversion and trend filters is tested. The hybrid improves performance noticeably. It filters many bad setups triggered during heavy momentum. It waits for calmer conditions before taking entries. Even the hybrid struggles during extreme volatility spikes. Crypto frequently creates unexpected large movements. These moves destroy predictive signals. The method becomes unreliable during such chaos. Results differ heavily from one coin to another. Some coins revert frequently, while others trend powerfully. This inconsistency makes the approach unpredictable. Emotionally, the method is very stressful. Holding a trade while price keeps moving against you is difficult. Waiting for the bounce becomes mentally exhausting. The method demands strong patience. Profit targets are small in most cases. A single large loss can erase many small gains. This creates a negative overall effect. Professional traders usually avoid pure mean reversion in crypto. They only use it in calm markets. Crypto rarely remains calm. This reduces the long-term reliability of the method. Backtesting confirms these issues clearly. The method shows brief profitable streaks but cannot maintain consistency. It requires too many filters to function properly. The simplicity disappears as more conditions are added. The approach becomes slower and heavier. Crypto rewards fast and aggressive systems, not slow reversal systems. This is why mean reversion weakens in digital assets. The conclusion is that the method struggles without heavy modifications. The risk-to-reward structure is poor. The emotional pressure is high. The inconsistency across coins creates uncertainty. Automation becomes difficult because of the complexity. The method is not strong enough for long-term usage. The testing clearly shows that it cannot compete with stronger approaches. This completes the full explanation of the third method. The next part will move into the fourth strategy. Algorithmic trading is a method where rules are converted into automated systems. These systems execute trades without emotional influence. The core idea is to let the machine follow instructions with perfect discipline. Crypto markets run 24 hours a day, which makes automation extremely useful. Human traders get tired, but automated systems never stop. This gives bots a major advantage in fast-moving markets. Algorithmic systems can scan multiple charts at the same time. They can detect patterns, volume spikes, and volatility shifts far quicker than any human. These systems react instantly when conditions match the predefined rules. Because of this speed, bots can take trades humans would miss. The testing process for algorithmic systems involves designing a complete rule set. The rules include entry conditions, exit logic, risk control, and asset selection. A typical system uses indicators like moving averages, volume filters, volatility bands, or momentum scanners. Some systems rely purely on price action. Others mix several technical tools to improve accuracy. Once the rules are complete, the bot executes them without hesitation. This eliminates emotional mistakes that often ruin manual trading. Greed, fear, and hesitation disappear completely when the bot is active. This is one of the biggest strengths of algorithmic systems. Every decision becomes consistent because the bot follows the same rules every time. In this testing session, the algorithmic approach is applied to multiple crypto pairs. A long period of historical data is used to understand how the bot performs through different market phases. The system is checked during bull cycles, bear cycles, and sideways markets. The bot takes trades whenever conditions align. All trades are recorded and evaluated. The results show that automated systems perform best when the rules are clear and simple. Complex rules often make the bot slow and unstable. Simple logic reacts faster and adapts more easily to changing market behavior. High-frequency bots perform many trades per day. These bots depend heavily on extremely fast execution and low spreads. Crypto exchanges are sometimes unstable, which affects high-frequency bots negatively. Latency, server delays, and network issues can cause missed trades or slippage. This decreases performance sharply. Medium-frequency systems work better for normal crypto traders. These systems take fewer trades but maintain better accuracy. Low-frequency bots focus on longer-term signals. They rely on strong trend shifts or major volatility events. These bots offer the most stable results with the least noise. During testing, automation proves to be powerful when the market behaves cleanly. Bots follow trends perfectly and exit when the rules say so. This leads to consistent returns during trending periods. Problems appear during chaotic or erratic market conditions. The bot continues to follow rules even when the market becomes unpredictable. Unlike humans, the bot cannot feel danger or instability. It cannot recognize news shocks unless programmed for it. This rigidity becomes a weakness. Sudden crashes or unexpected announcements cause rapid losses. The bot executes its rules without understanding context. Because of this, algorithmic systems require strong protective filters. Volatility filters can prevent trading during dangerous spikes. Volume filters remove bad trades during thin liquidity periods. Time filters block trades during unstable sessions. Adding these protections improves results significantly. Risk management is crucial for automated systems. Bots usually perform best with fixed risk settings. Position size, stop-loss placement, and maximum exposure must be controlled. If the bot uses too much leverage, the system becomes unstable. When risk settings are balanced, performance becomes smoother. Another important factor is over-optimization. Many traders design bots that work perfectly on past data. These bots fail when used in live conditions because they were built to fit history too perfectly. This mistake is known as curve fitting. A well-designed bot must be robust across different time periods. It must function well even if market conditions change. The testing results confirm that simple rule-based bots perform more reliably in live conditions. Bots that rely on too many filters collapse when conditions shift. The best systems react quickly, avoid complexity, and control risk tightly. Crypto volatility actually helps algorithmic systems when the trend is strong. Bots capture large moves faster and more efficiently than manual traders. During sideways phases, bots struggle, especially if their rules depend on directional strength. These phases create a lot of false signals and random noise. This increases losses even with advanced filters. Automated systems also require continuous monitoring. They do not think, so they cannot repair themselves when conditions break down. Maintenance is necessary to adjust for new market patterns. Despite these drawbacks, automation remains one of the most scalable approaches. Bots can trade multiple coins at once. They can handle 20 charts simultaneously without losing focus. This increases opportunities and improves long-term profitability. Algorithmic systems also allow instant diversification. A single trader can run several strategies at the same time. One bot can focus on trends. Another can analyze breakouts. Another can monitor volatility squeezes. This multi-bot structure creates a more stable performance curve. In the final evaluation, algorithmic trading proves to be one of the stronger approaches when designed properly. It removes emotions, increases consistency, and expands market coverage. It struggles during chaotic volatility and requires strong risk controls. But with proper rules and ongoing maintenance, the method becomes highly effective. This completes the deep explanation of the fourth method. The next part will move into the fifth and final strategy in the testing process. Breakout trading is based on the idea that when price escapes a tight range, a powerful move often follows. This approach focuses on identifying periods where the market compresses and then suddenly expands with energy. Crypto markets are filled with explosive moves, which makes this method extremely appealing. The foundation of this approach is simple. Wait for price to build pressure inside a narrow zone. This zone forms because buyers and sellers reach temporary balance. As the balance tightens, the market becomes more unstable. A breakout happens when one side overwhelms the other. This shift creates a burst of momentum that pushes price strongly in one direction. Breakout traders attempt to capture that burst. In this testing session, breakouts are examined using multiple crypto assets across several years. The first step is identifying consolidation zones. These zones form when price moves inside a narrow range for an extended period. The range becomes a signal that energy is building beneath the surface. Breakout setups often include patterns such as triangles, flags, wedges, or simple horizontal boxes. These structures help define clear support and resistance boundaries. A breakout occurs when price closes above resistance or falls below support. Volume increases during breakout moments, confirming market interest. This makes volume a critical supporting tool for this method. Crypto markets are highly reactive to breakouts. When a breakout forms, movements are often sharp and fast. Traders who react late often miss the best entries. This is why breakout systems rely heavily on predefined rules and fast execution. One of the biggest strengths of this approach is its alignment with momentum. Instead of fighting strong moves, breakout traders follow them. This reduces the emotional pressure of guessing tops or bottoms. The method uses price strength as proof of market direction. This creates a logical and straightforward approach to trading. During testing, breakouts were categorized into two major types: continuation and reversal breakouts. Continuation breakouts occur when the trend pauses briefly before continuing. Reversal breakouts occur when the price breaks out in the opposite direction after a long trend. Continuation setups were far more consistent in crypto. Reversal breakouts were less reliable because crypto trends often extend longer than expected. This behavior makes continuation patterns the preferred option. Breakout trading requires confirmation to avoid fake moves. False breakouts are common in crypto due to liquidity manipulation and sudden volatility spikes. These fake moves occur when price briefly escapes the range but quickly returns inside. These events cause losses for traders who enter without confirmation. To reduce this problem, the testing process used filters such as increased volume, multiple time-frame validation, and candle close confirmation. These filters significantly reduced the number of bad entries. They improved accuracy by focusing only on strong and genuine breakout moments. Risk management plays a major role in breakout systems. The most common technique is placing a protective stop just inside the range. This ensures that losses remain small if price returns back inside the zone. Because breakout trades aim for large moves, the risk-to-reward structure becomes highly favorable. A single successful breakout often produces more profit than several small losses combined. This dynamic makes the approach scalable and mathematically strong. During testing, breakout systems achieved their best performance during trending phases. Strong bull runs and deep bear phases offered many clean entries. The method captured large portions of these moves with minimal signals. In sideways markets, however, the approach struggled. Ranging environments produced many fake breakouts. These false signals created clusters of small losses. Even with filters, sideways conditions remain difficult for this strategy. This shows that breakout trading works best when the overall market provides direction. Another key observation is that crypto reacts well to volatility squeezes. When volatility drops extremely low, the breakout that follows is usually explosive. These volatility compression zones produced some of the best results in the entire test. The strength of these moves often exceeded the performance of other strategies. Breakout traders who wait patiently for these rare setups often enjoy strong long-term performance. Automating breakout systems proved effective as well. Bots can detect breakouts instantly and execute faster than manual traders. This speed increases the probability of entering at the best possible level. Automation also removes hesitation, which is a common problem in breakout trading. Many traders fear entering because breakouts move fast. Bots eliminate this emotional delay. This combination of speed and discipline improves performance significantly. Despite its strengths, breakout trading has weaknesses that must be respected. The method suffers during messy markets. It requires patience and avoidance of low-quality setups. It also requires strong risk management because false breakouts are unavoidable. However, the overall testing results show that the approach outperforms many other strategies when markets trend strongly. Its ability to capture large directional moves makes it extremely powerful in the crypto environment. When the testing session ended, breakout trading ranked as one of the most effective methods. It performed consistently well during high momentum periods. It recovered quickly after drawdowns. It maintained a strong overall profitability curve. Its mathematical structure proved sound, especially when risk was controlled and confirmation filters were used. This made breakout trading one of the top-performing strategies in the entire 5-strategy test. This completes the deep explanation of the 5th method. Momentum trading sounds simple because it tells you to buy when the price is rising and sell when the price slows down. The strategy became extremely popular because it works in traditional markets where volatility is lower. Crypto, however, behaves differently because price movements are explosive and unpredictable. Most momentum traders enter a trend too late because the market moves extremely fast. When the price is already moving parabolically, it often means the biggest part of the move is already gone. Late entries cause traders to chase pumps that reverse within minutes or even seconds. Crypto whales intentionally create strong momentum to trap retail traders. These traps are engineered to make normal traders buy high and panic sell low. Momentum strategies fail because liquidity in crypto is thin compared to stock markets. Thin liquidity increases the chance of sudden wicks that completely invalidate momentum signals. On lower time frames, momentum becomes almost meaningless because bots dominate execution. Bots react thousands of times faster than humans and always capture momentum first. A human trader reacting afterward is almost always entering at the worst possible moment. The problem becomes even worse when traders rely on lagging indicators. Indicators like RSI, MACD, and stochastic turn overbought or oversold too late. By the time these indicators confirm a trend, the move is already exhausted. Momentum signals generate many false breakouts in crypto because volatility is extreme. False breakouts wipe out traders before they can exit the position. Trend strength indicators often give conflicting signals in sideways markets. Crypto spends most of its time in sideways behavior where momentum strategies fail repeatedly. Sideways markets produce endless whipsaws that destroy momentum-based accounts. Whipsaws happen when the price quickly moves up and down without direction. These movements hit stop losses and create emotional frustration. Momentum traders usually increase their position size after a streak of losses to recover quickly. This behavior leads to massive drawdowns and blown accounts. Emotions play a huge role in why momentum fails for most traders. Fear of missing out pushes traders to enter without proper analysis. Fear of loss forces traders to exit too early, losing potential gains. Crypto influencers often hype momentum strategies during bull runs. Bull markets make every strategy look profitable, even if the strategy is weak. Momentum only appears to work consistently when the entire market is trending strongly upward. During bear markets, momentum strategies collapse because trends are short-lived. Even during bull markets, momentum tends to fail once volatility increases too much. High volatility makes trends unstable, unpredictable, and extremely dangerous to trade. Momentum traders often ignore fundamental news that can instantly reverse market direction. News events like regulatory announcements or exchange hacks kill momentum instantly. Momentum trading becomes even more dangerous when traders use leverage. Leverage amplifies both profits and losses, and in momentum trading losses escalate fast. Liquidations happen quickly, especially on platforms with aggressive liquidation engines. Most momentum traders underestimate how quickly liquidations occur in crypto. A small wick against the position can erase the entire margin instantly. Many momentum traders switch timeframes, constantly trying to find a perfect setup. Switching timeframes causes confusion and inconsistent decision-making. A strategy without consistency cannot be profitable in the long term. Backtesting momentum strategies in crypto often gives false confidence. Historical data does not capture the full randomness of future volatility. Market conditions change constantly, making past momentum patterns unreliable. Traders rely too much on historical indicators that do not adapt to modern market behavior. Crypto is an evolving market that punishes outdated strategies. Momentum thrives only when the market has high liquidity and low unpredictability. Crypto rarely maintains these conditions long enough to favor long-term momentum success. Algorithmic trading firms exploit momentum patterns far better than human traders. Humans trading momentum are competing against systems that analyze millions of data points in real time. This imbalance ensures that retail traders lose more often than they win. Whales monitor regions where momentum traders enter and place stop hunts in those areas. Stop hunts are deliberate attacks designed to liquidate leveraged positions. Stop hunts destroy the core structure of momentum setups. Psychological pressure increases with every failed trade. Traders become desperate and break their own risk management rules. A strategy without strict discipline cannot survive in the crypto environment. Momentum trading forces traders to constantly monitor charts for hours. This leads to mental fatigue and poor decision-making. Fatigue causes emotional trading, which is the biggest enemy of momentum strategies. The true reason momentum fails is that traders expect consistent trends in an inconsistent market. Crypto's structure does not support long, clean trends except during rare cycles. Momentum strategies are incompatible with chaotic price behavior. Successful traders know that momentum is not reliable enough to build long-term profitability. The few traders who make money with momentum rely heavily on automation and advanced execution tools. Retail traders cannot compete with such speed and precision. Momentum may look attractive on paper, but reality proves it wrong again and again. Understanding this truth helps traders avoid one of the most costly mistakes in crypto trading. Avoiding a bad strategy is as important as mastering a good strategy. Backtesting looks powerful because it shows how a strategy would have performed in the past. Many traders use backtesting to convince themselves that a strategy is profitable. The problem begins when traders assume the past will behave exactly like the future. Crypto markets change so fast that historical behavior rarely repeats perfectly. Most backtests create a false sense of confidence that collapses during real trading. Backtesting often hides the chaotic randomness that appears in live markets. Data used for backtesting is usually cleaner than real-time trading conditions. In real markets, slippage, latency, and liquidity issues distort trade entries. Backtests cannot simulate the emotional stress of real trades. Emotions influence decision-making in ways backtesting never accounts for. Traders who perform backtests often remove losing trades unconsciously. This creates curve-fit results that look perfect, but never work live. Curve fitting happens when a strategy is adjusted too precisely to past data. Such strategies perform beautifully in the past, but terribly in the real world. Backtests rarely consider sudden volatility spikes that destroy live trades. Unexpected news events instantly break patterns that worked historically. Most crypto assets lack long-term reliable data for strong backtesting. Limited data means traders rely on incomplete or inaccurate testing results. Many backtesting tools do not include real exchange order book behavior. Order book changes greatly impact whether a trader gets filled or not. Backtests often assume perfect entries and perfect exits. Real trading always includes delays that alter entire results. Backtesting does not simulate partial fills that commonly happen in crypto. Partial fills change risk management and often ruin trade setups. Many traders use data from bull markets to test their strategies. Bull market results make even weak strategies appear profitable. When market conditions shift to a bear cycle, those strategies collapse. Backtests that only consider trending periods ignore sideways conditions. Sideways markets break trend-based systems and create countless fake signals. Backtesting also fails to simulate how liquidity disappears during crashes. During massive dumps, trades slip heavily, and exit orders fail to trigger. Backtests assume exit points always execute at exact target prices. Real markets often skip straight through targets without filling orders. Backtests usually ignore funding fees in perpetual futures. Funding fees accumulate and destroy profits over long periods. Many profitable-looking backtests lose money after funding fees are included. Backtesting also ignores exchange downtime or API delays. During critical market movements, exchanges often freeze or lag. These freezes make it impossible to follow the strategy in real time. Backtested strategies rely heavily on perfect data feeds. Real-time feeds often lag or produce inconsistent signals. Backtests cannot replicate the behavior of large players or whales. Whales manipulate markets in ways that algorithms cannot predict. Whale activity causes sudden reversals that destroy backtested setups. Liquidity providers can pull liquidity instantly, creating unexpected volatility. Backtests assume liquidity remains stable throughout price movement. This assumption breaks completely in live crypto trading. Many backtests use unrealistic position sizes that would not execute in real markets. Large positions in low liquidity coins create major slippage. Backtests hide slippage by calculating idealized execution prices. Real execution often produces worse outcomes than expected. Backtests cannot simulate emotions like fear, greed, and hesitation. These emotions cause traders to exit early or enter late. Breaking consistency destroys the strategy's profitability. Backtested winning streaks give traders unrealistic expectations. Unrealistic expectations lead to oversized positions and emotional burnout. Most backtests ignore exchange trading fees that accumulate rapidly. Trading fees reduce net profits far more than traders anticipate. When fees are included, many backtested strategies become unprofitable. Backtesting also encourages traders to constantly adjust their systems. Constant adjustments make the strategy unreliable and inconsistent. Inconsistent systems fail in unpredictable crypto markets. Backtesting provides a false sense of security that collapses quickly in real trading. Many traders quit after realizing their backtested system only worked on paper. The failure destroys trust in strategies and confidence in trading ability. Professional traders treat backtesting as a reference, not a guarantee. They understand that live markets behave very differently than historical charts. Successful traders prioritize risk management over backtest results. They focus on adapting strategies to real-time behavior instead of relying on old data. Backtesting can be useful only when combined with continuous adjustments. The best traders adapt to current volatility instead of trusting past performance. A strategy that survives live trading is far more valuable than a perfect backtest. Backtesting is a tool, not proof of profitability. Most traders fail because they treat backtest results as reality. The truth is that only forward-tested, real-time strategies prove true reliability. Understanding this prevents traders from building false confidence in faulty systems. This realization protects traders from relying on strategies that collapse under real pressure. Grid trading is one of the most popular automated strategies in the crypto world. The idea behind grid trading is simple and easy to understand. You place multiple buy and sell orders at fixed intervals and let the market fill them automatically. This creates a grid of orders that profits from small price fluctuations. The strategy sounds logical because crypto has constant volatility. On paper, it looks like free money because every small move becomes a profit. However, grid trading begins to fall apart the moment the market becomes unpredictable. Crypto does not move in stable ranges long enough for grid systems to work profitably. Most coins stay in consolidation for a short period and then explode violently in one direction. When that breakout happens, grid trading suffers massive losses instantly. Grid bots buy heavily during a dump and keep buying as the price keeps crashing. This creates a large inventory of losing positions that becomes impossible to exit profitably. The trader is forced to hold huge drawdowns for long periods. In many cases, the losses grow so large that they wipe out months of small profits. Grid trading fails because it performs well in calm markets, but collapses in trending markets. Crypto trends extremely hard, and trends destroy grid systems very quickly. Grid traders often believe they can predict ranges. The ranges in crypto are never reliable. A sudden breakout invalidates all the accumulated positions on one side of the grid. When the market moves in one direction for too long, the grid bot is helpless. It keeps executing losing trades because it is programmed to follow the grid structure. The strategy has no intelligence to stop trading during dangerous conditions. Most grid bots lack built-in risk management systems. They continue generating positions even when the trader's account is in danger. This makes grid trading extremely risky for beginners. Another major issue is that grid trading does not scale well with high volatility. Extreme volatility causes orders to fill too quickly and lock in rapid losses. During large wicks, the bot executes buy and sell orders in seconds, creating a mess of random trades. These rapid fills increase trading fees dramatically. Trading fees eat away the small profits that grid bots generate. Many bot users do not realize that fees can turn a seemingly profitable grid system into a losing machine. On many exchanges, the fee cost is larger than the profit made by each grid order. This results in a net negative strategy, even if the bot appears to be working. Liquidity is another problem for grid trading. Low liquidity coins cause huge slippage that ruins the grid structure. Slippage makes the bot enter positions at worse prices than planned. The distorted execution destroys the mathematical balance of the grid. Once the balance breaks, the entire strategy becomes unstable. Many traders think running a grid bot 24/7 is passive income. In reality, it is extremely dangerous because markets can shift violently at any moment. During black swan events, grid trading produces catastrophic losses. Examples include massive exchange hacks, regulatory announcements, and market-wide crashes. These events create one-direction moves that wipe out grid systems instantly. Grid traders assume the bot will stop itself during danger, but most bots continue trading blindly. The bot is designed to follow instructions, not to think or adapt. The lack of human intervention during crashes makes grid trading extremely risky. Most successful grid traders use tight risk control and constant monitoring. They adjust grid settings based on market conditions instead of letting it run blindly. However, beginners rarely have the skill to manage grids properly. Most beginners leave the bot running and check it occasionally. By the time they notice something is wrong, it is usually too late. Another issue is that grid trading requires significant capital. Without enough capital, the grid will not survive large market moves. Small accounts get liquidated or forced into huge drawdowns quickly. Large accounts can survive longer but still suffer massive losses during extreme volatility. Grid trading also suffers from psychological challenges. Traders panic when drawdowns become too large to handle emotionally. This panic leads to shutting down the bot at the worst possible time. Stopping the bot in the middle of a trend locks in huge losses. This turns temporary drawdowns into permanent damage. Grid trading can also trap traders into holding dead coins. If a coin dumps heavily, the bot accumulates massive positions at high prices. The trader is then stuck holding assets that may never recover. Many grid traders end up becoming long-term bag holders without planning to be. This is one of the most dangerous outcomes of grid trading. Another flaw is that grid trading works best when the market moves sideways. Crypto rarely behaves sideways for long enough to support the strategy. Sideways markets often transition into major trend moves without warning. By the time the trader realizes the range is breaking, the damage is already done. Grid trading promises automation but delivers stress when the market becomes unstable. Automation helps only when the underlying strategy is safe and robust. Grid trading is neither safe nor robust in a market as volatile as crypto. The strategy relies too much on market stability, which crypto does not provide. Even professional traders avoid grid systems during unpredictable phases. Only highly skilled traders with deep market understanding can run grids safely. Even then, the returns are much lower than the risk taken. For most retail traders, grid trading becomes a slow path to a major loss. The small profits create false confidence, and the big losses destroy accounts. Understanding these risks prevents traders from falling for the illusion of safety in grid trading. Avoiding poorly designed automated systems is essential for long-term survival in crypto. Indicators are one of the first tools new traders learn to use in crypto. They look scientific, mathematical, and reliable at first glance. Many traders believe indicators will help them predict future price movements. The reality is that most indicators lag behind the market and cannot keep up with crypto volatility. Crypto moves faster than traditional markets, making indicators react too slowly. By the time an indicator confirms a signal, the market has usually moved already. This lag creates entries that are late and exits that are poorly timed. Late entries lead to buying the top and selling the bottom. Most traders fail because they trust the indicator more than the actual price action. Indicators were designed for stable markets, not chaotic crypto behavior. Traditional indicators like RSI and MACD struggle to interpret extreme volatility. Volatility causes indicators to flip signals rapidly and produce confusion. Confusion leads to emotional decision-making and inconsistent trading. When traders become inconsistent, they lose money quickly. Indicators often give conflicting signals depending on the time frame. A buy signal on one time frame may appear as a sell signal on another. This contradiction makes traders second-guess their decisions constantly. Second-guessing destroys confidence and causes hesitation during important moments. Hesitation results in missed opportunities and poorly timed trades. Most traders load too many indicators on their charts. Too many indicators lead to analysis paralysis. Analysis paralysis prevents traders from taking clear and decisive action. Indicators do not understand context, market structure, or narrative. They cannot interpret news events or whale movements that disrupt patterns. Whenever big players manipulate liquidity, indicators become useless. Whale-driven pumps and dumps override every indicator signal instantly. Crime events, exchange failures, or sudden policy changes break every indicator setup too. Indicators cannot predict irrational market behavior, which happens frequently in crypto. Indicators assume price moves logically, but crypto is driven by emotion and speculation. Speculation creates unpredictable swings that indicators fail to capture. Most traders use indicators without understanding how they work mathematically. Blind usage leads to blind trading. Blind trading leads to blind losses. Indicators like stochastic constantly go overbought or oversold in trending markets. This makes traders think a reversal is coming even when the trend is just starting. Traders exit too early because the indicator says the asset is overbought. They miss massive profits because they trusted the indicator over the trend. Indicators are designed to follow price, not lead price. A following tool cannot forecast future movements accurately. Many traders misuse moving averages and believe crossovers are guaranteed signals. Moving averages lag heavily, causing the crossover to happen after the big move. This lag creates delayed entries that have no edge in fast markets. Indicators cannot adapt to different market phases automatically. Trending markets require different indicator settings than ranging markets. Most traders never adjust indicator settings to match current conditions. Incorrect settings produce inaccurate signals that cost money. Even adaptive indicators struggle during sudden volatility spikes. During high volatility, the market changes direction too fast for indicators to process. Indicators repaint signals, meaning they change after the candle closes. Repainting misleads traders into believing the indicator was always accurate. This illusion creates false trust in an unreliable system. Crypto indicators often fail because of liquidity differences across exchanges. Different exchanges show slightly different pricing data. Indicators that rely on price data produce inconsistent results depending on where they are calculated. This inconsistency introduces noise into the trading strategy. Indicators cannot detect long squeezes or short squeezes created by market makers. Squeezes trap traders on the wrong side while indicators fail to warn them. Indicators cannot detect liquidation cascades that cause violent price movements. Liquidations create sudden moves that indicators cannot process in real time. Most indicators do not account for funding rates or futures market mechanics. When funding rates flip, indicator signals lose meaning instantly. Indicators cannot account for open interest spikes, which signal aggressive positions entering the market. Without open interest awareness, indicator signals become incomplete and misleading. Most beginners trust indicators more during their first profitable trades. This early success creates overconfidence. Overconfidence leads them to trade bigger and riskier setups. Eventually, the indicator gives a bad signal that wipes out previous profits. Most traders do not realize that every indicator is just a mathematical transformation of price. This means indicators are simply reinterpreting what is already visible on the chart. If a trader cannot understand price action, the indicator will not help them. Indicators only confirm what already happened, not what will happen next. True prediction comes from reading market structure, not from indicator arrows. Indicators also fail because they cannot filter out market noise. Noise in crypto is much higher than noise in traditional markets. Noise triggers fake signals and false breakouts. Fake signals cause traders to enter losing trades repeatedly. Repeated losses create frustration and emotional burnout. Burnout makes traders abandon strategies prematurely. Indicators give the illusion of control by providing visual patterns. This illusion tricks traders into thinking the strategy is safe. A safe strategy does not require hope and luck to work. Most indicator-based strategies rely on hope more than logic. Professional traders use indicators only as a secondary confirmation tool. They rely primarily on liquidity zones, volume analysis, and market structure. Indicators are optional, not essential, for consistent trading. Traders who depend entirely on indicators rarely succeed long-term. The power of indicators is overstated and misunderstood by most. Understanding their limitations protects traders from blind reliance. Knowing when not to use indicators is more important than choosing which indicator to use. The fewer indicators a trader uses, the clearer the trading decisions become. Trading clarity comes from understanding the market, not from indicator signals. Clarity reduces hesitation and improves execution drastically. Removing indicator noise allows traders to see the real movement of price. Price action speaks directly while indicators whisper indirectly. Direct information always wins over indirect interpretation. Most successful traders eventually stop using indicators for decision-making. They shift to pure price action because it provides the most accurate picture. This shift marks the transition from beginner-level thinking to professional-level trading. Copy trading looks attractive because it lets beginners follow experienced traders automatically. It creates the illusion that you can profit without learning anything. Many platforms market copy trading as an easy shortcut to success. The truth is that copy trading fails for most people who try it. Copy traders do not understand the strategy behind the trades they are copying. Without understanding the strategy, they panic when losses appear. Panic causes them to close trades too early or break the system. Breaking the system destroys the entire purpose of copy trading. Most traders on copy trading platforms use risky strategies to appear profitable. They take huge leverage to boost short-term results. Short-term success attracts more followers and higher profits from fees. The followers do not realize the trader is taking reckless risks. Eventually, the risky strategy collapses and wipes out both the trader and the followers. This cycle repeats constantly because platforms reward traders who show fast gains. Fast gains often come from dangerous high-leverage positions. High leverage is unstable and leads to sudden liquidation during volatility. Copy trading exposes beginners to liquidation without them even realizing it. Most copy traders do not know how much risk they are actually taking. They trust the system blindly because they believe the professional knows what they are doing. Many professional-looking traders are not professionals at all. Some manipulate their performance statistics to attract followers. Some hide losing trades to show artificially high win rates. A trader with a high win rate may still have terrible long-term performance. Win rate alone does not show risk levels, drawdowns, or hidden losses. Copy traders are misled by pretty charts instead of real metrics. Real metrics include risk exposure, leverage usage, and maximum drawdown. Most platforms do not display these metrics clearly. This lack of transparency is intentional because it attracts more followers. Copy traders often join during the peak of someone's winning streak. Once they join, the streak usually ends. This timing leads to immediate losses for the followers. Followers blame the trader, but the real issue is market timing and lack of understanding. Many copy trading leaders use martingale-style strategies. Martingale strategies double the position size after each loss. This creates long streaks of small profits. Eventually, the streak ends with one massive loss that destroys the entire account. Copy traders are unaware of this danger until it is too late. They do not see the hidden risk accumulating behind the scenes. Platforms highlight profit percentages instead of showing risk factors. This marketing trick makes dangerous traders look safe and reliable. Copy traders assume consistency based on short-term performance. Short-term consistency means nothing in a highly volatile market. Many copy traders trade in ways that suit their risk tolerance, not the followers' tolerance. Followers do not realize their emotional limits until real losses occur. Emotional differences between the leader and the follower cause major problems. A leader may be comfortable with large drawdowns because they trust their method. A follower panics and closes the trade at the worst time. Emotional mismatch destroys the strategy instantly. Copy traders often join with too much capital. They invest large amounts because they think copying eliminates skill requirements. When losses come, they react emotionally because the money feels unsafe. Emotional panic leads to abandoning copy trading prematurely. Abandoning early locks in losses and prevents recovery. Another major issue is that copy trading does not adapt to changing market conditions. What worked last month may fail badly this month. Market cycles shift constantly and crypto and strategies must evolve. Most copy traders do not adjust quickly enough to survive every phase. When a strategy becomes outdated, followers suffer instantly. Copy trading also fails because followers do not use proper risk management. They copy without setting their own limits or safety rules. Relying fully on someone else's decisions is extremely dangerous. No trader can protect someone else's money with full responsibility. Most copy traders do not understand the risk of open interest spikes. They do not understand funding fees or liquidation points. They do not understand position sizing or volatility analysis. A follower without knowledge becomes vulnerable to every market mistake. Many followers also copy multiple traders simultaneously. Copying multiple traders creates conflicting signals. These conflicting positions cancel each other out and increase risk. The portfolio becomes chaotic with no clear direction. Chaos leads to big losses when the market becomes volatile. Copy trading also suffers from transparency problems. Some platforms delay trade execution for followers. Delayed execution leads to worse entries and exits. Worse executions change profitable trades into losing trades. This delay is invisible but extremely harmful. Followers think they are copying exactly, but they are not. Sometimes the leader's trade fills instantly, while the follower's fills late. The price difference ruins the trade before it even starts. Another hidden problem is liquidity. When a trader with many followers enters a position, it creates slippage. Slippage causes followers to enter at worse prices than the leader. The leader profits while the followers receive inferior entries. This inequality makes copy trading unfair and unbalanced. Copy trading works only when the follower fully understands the strategy. Most do not understand the strategy at all. Copy trading also requires trust, but trust in crypto is dangerous. Even honest traders can make sudden mistakes. One mistake can wipe out months of progress. Copy traders expect perfection, but perfection does not exist in trading. The best traders still experience massive drawdowns during difficult market conditions. Followers cannot handle these drawdowns emotionally. They quit at the exact moment the strategy is about to recover. Timing mistakes destroy any chance of long-term success. Copy trading promises easy profits, but delivers complex psychological challenges. It removes learning, but increases risk. It removes control, but increases responsibility. It removes understanding, but increases emotional stress. This imbalance leads to failure for most people who attempt it. Only traders who learn the principles themselves succeed in the long term. Copy trading may look like a shortcut, but it is actually a trap disguised as convenience. Avoiding blind copying protects traders from unpredictable losses. Understanding the market is the only real path to consistent success.